Hello and welcome. You're watching NDTV Profit, and it's the run-up to Diwali, Profit Wali Diwali like we're calling it. The markets, of course, supporting that sentiment on the street today. All eyes will be in the festive season, and it is Dhanteras tomorrow. So keeping that in mind, we decided to make this show a special one where we tell you whether or not you should be adding and how much should you be adding gold to your financial portfolio. Well, over the next 20 minutes, I will try and assess whether or not gold looks like an asset class that one should aggressively invest in, or should it be just cultural in that sense. Joining me on the show are going to be Mehta, CIO of Quantum AMC, and Chintan Mehta, CEO of Abans Holding. Thank you, gentlemen, for joining us today on the show. Right, we also have with us Chintan Mehta, who joins in. Chintan, you know, we talk about gold at least once a year during this time, right? Just before Dhanteras, everyone was talking about gold and the outlook of gold. But the fact remains, as we've talked about it this year a lot more than we've done historically, largely because of the kind of performance that we've seen on gold prices. How do you feel about gold? Do you feel the outlook still looks very constructive? And I know while it has an important role in a strategic portfolio, tactically as well, is gold a good buy?
Gold, I see always a good buy. Over a period, if you see, that's what I was even telling one of our friend also. If you see from last 15 years, gold has gone up from 12,000 to 80,000 rupees, especially in Indian terms with the currency depreciation and the kind of geopolitical tensions going around in the Middle East. Plus, if you see fundamental change, what is happening is a currency crisis. Initially, what used to happen is USD was a king, but slowly, if you see, there are a lot of shifts from this. So ultimately, we have to decide what is the next reserve currency it can be. So gold and the Bitcoin are the two major component we can think, but gold has a larger history, proven history, a track record from a very long point of time. So I see gold in a current situation as a great buy, and it's in a good bull run. But once again, it has rallied from the lows of 2200 to 2700 in a no time. So it might take a little breather here, but in a long term, it is still a very, very good buy, and everybody have to have a chunk of gold in that portfolio. And I would say sizing should be sizable, not like before where we just have to be like 4 to 5% on our portfolio.
Right. Chintan, how much percent of one's portfolio should be allocated to gold? And I'm talking with somebody who's average age with an average risk profile. The bias is to equities for wealth creation.
I think in a current situation, your portfolio allocation should be in a gold should not be less than 15 to 20%, depends upon what exactly the financial arrangement one has made, because gold has been given a good return, which was not the case initially, and it is a hedge against the other investment like equity, real estate. In case of difficult years, gold will outperform, and on a normal years also, with the kind of situation we are into, which is a downward interest rate, and the real interest rates are going to be for a gold would be positive, you know. So 20% is my punt, it's minimum, and I always have loved gold. And if you see the returns over a period of time in equity index, if I see, it's around 13% per annum since inception, and gold would be somewhere around 8 to 10%. But the kind of comfort and the kind of the solidity which it gives, you know, it's tremendous. So I would say minimum 20% investment for the middle age and the medium income size.
Chintan, what about you? What do you recommend to your clients? What is a preferred instrument to invest in gold?
See, I think Chirag has spoken very nicely that whatever is there to consume, I think physical is the natural choice, and with the kind of demography of our population, every year marriages are going to be on a top of the list, whereas female have to wear the ornaments or have to consume gold. That is where the physical gold comes into play. And that is why we see that even though we import on an average somewhere around 800 tons of gold every year, but AUM in gold ETFs are not more than 60 tons, you know, only 60 tons. Whereas in a globally where people are not consuming gold, it is still at 3,000 tons. So there is a long way to go. People are still believing in physical, but yes, trend has to change, and investment product, whatever our clients have to make, we always suggest them as an ETF. ETF is a wonderful product where you can marginize it also. So if somebody is playing a derivatives, then he can also pledge these units and get the margin. So as per my understanding, whoever wants to levered return, they can maximize the return by leveraging it through ETFs and fund of fund or the multi-asset fund. Okay, so whatever is there for the consumption, you please buy it in physical. Otherwise, paper products are the best products.
Paper products, the best products, and then begins the debate. Chintan, do you feel like gold and silver are interchangeable and silver is a good proxy to gold? So if not gold, can somebody look at adding silver to their portfolio?
No, big no. This is, I would not like to go away with the common contention people what make is silver can run away and it can replace in a gold as a portfolio to make a better return, because silver in a span it might run, you know, very high than the gold. But if you see in a long run, so I was just giving a stat to someone, if you go to somewhere around 2010, silver was available at 25,000 rupees per kilo and gold was available at somewhere around 12,000 rupees per 10 grams. Right now it is at 80,000 rupees per 10 gram for gold, and it is just the 4 times in silver. Plus gold is a perfect hedge. It acts like a currency in case of any global disruption, any risk to the currency or the war zones, whereas silver acts like a more of an industrial metal. When something goes wrong, it is the one which goes down terribly. You know, if you see the COVID, if you see the Lehman Brothers, and it doesn't give you that base where you can depend upon the return what you can depend upon the gold. Gold is like an elephant. It just doesn't move like that. The volatility of silver is somewhere around 22, whereas gold is around 10. So it's very solid, plus it is giving returns. So what's the point shifting it to silver?
It's a role of adding stability to the portfolio, so you don't want to take that away. In your opinion, because of course you don't represent a single instrument in that sense, where do you think, or where is your bias? So when you recommend to your clients to go out and invest in gold, what is your preferred route of investments, keeping in mind taxation, costs, and everything else?
We always recommend depend upon the investor's profile, but this is a very generic question because it has come now. So if somebody wants a mix of it, you know, then the multi-asset funds are the good asset, because there the portfolio manager can decide about what percentage they wanted to invest into gold or equity or fixed income. Because every asset class of the capital market gives at different time a different kind of return. So if somebody is in the current horizon, you know, where gold is already rallied, but fixed income is still keeping it long, I would suggest in a multi-asset fund, investor means portfolio manager would put his weightage on the GSEC more, because it also comes with a capital gain. So interest rate is inversely related with the GSEC price. So if interest rate starts going down, I think with a levered return what GSEC can generate, fixed income can generate, will outperform equity as well as gold. So my point would be on a multi-asset funds rather than just straight away investing into gold, you know, because it's just the one asset class. If you trust the fund house and the portfolio manager with their past track record, I think multi-asset funds are the better choice right now.
Multi-asset fund. I'll have you go for it because Chirag, you've been tracking this quite closely. I mean, it of course gives a broader perspective.
Yes, I think 5,000 rupees SIP, I think 3,000 one can go with the large cap fund or the index fund, and 2,000 we can just allocate towards a small cap fund, whereas average return what we can expect would be somewhere around 17 to 18% CAGR, which I think it's a very great size when you enlarge the period, you know. Compounding, I always say that it is the eighth wonder of the world. It looks pretty small, but when you expand the horizon or expand the time zone, it really gives you around, amazing return. So 3,000 toward large cap or the index fund and 2,000 toward the small cap, because India is a perfect place to invest right now.
Right, I agree. The power of compounding is what we talk about often. It's not timing the market, but time in the markets, which is very commonly said. With that, we're completely out of time. Chintan, Chirag, thank you for your time. Happy Diwali, happy Dhanteras, and may this be a good year for both of you. Thank you very much.